And there's a ton of contradictory things, a ton of things that are, I think, not clear. And I want to try and make it as clear and potentially, hopefully, as actionable as I can. And then after that, I'm, happy to take any questions. Before you guys joined, I just want to disclose one other thing, which is my son is graduated from Brandeis. My eldest was class of 16 and working in startup land. And he had a really good, positive Brandeis experience. He made the same mistake I was, which was he wasn't technical, but he loves technology, so much that he knew that's what he wanted to go do, and is now working there. And I think maybe at some point he may be starting his own thing at some point. But let me start. Let me start and go through 10 things that I would have wanted to know if I was starting a company from your guys' shoes. And I would say the number one thing that I start with is the most important thing you do is choose your founders wisely. 50% of companies that get funding early fail because of what we call founder drama, where the founders really don't get along that well. And a lot of times with college or fresh from college startups, what happens is you start with people that you were in class with, or maybe you were in the dorms with, that you kind of know, but you don't know if you can work together with them, right? And there's a whole bunch of bad things that happen when founder drama starts. First, what happens is if one of the founders leaves, you have a lot of equity left on the cap table. So if we're starting this really simply and say it's you and a buddy, the buddy leaves, there's 50% that person owns that's now dead money, right? And that makes it really hard when you have a non-contributing, non-investing 50%. It really is a red flag for investors. So one of the things that I advise people at this level is walk before you run, before you actually sign up to an agreement, and make sure you can work together. And even if you just do simple things like begin to do some projects together, begin to figure out what the division of labor is between you and your co-founder, right? Figure out if the equity is going to be equally split between the two of you, right? And then super important is figure out who the CEO is. And I found that decision is probably the one decision that leads to the most jealousy, right? When you're two people sitting in a dorm room, you can say we're equal, right? And we're both doing the same thing. But the reality is, who is CEO is the person who raises money and the person who goes and negotiates and closes customers. That's the person who has to be the CEO. And my guidance to you would be, if you can't figure out those questions early, don't go farther, right? That's your red flag to say, I've got the wrong partner. Okay. The second point is in terms of, choosing a product. And one thing that happens a lot of times, again, with college startups that I talk about is the advice is choose a market is out there, widely. And the problem is when you're, 21 years old, the market may well be the sneaker market, right? Which is not a bad market. The problem is, I don't know if you're going to be interested in the sneaker market in 8 years, right? Because you got to work on the same problem for a number of years. And I would make sure that you find a market you care about and that you're passionate about, and a problem that you can grow into, as opposed to one which you grow out of. And again, I see this, I see a lot of times the college startups, this becomes a big problem, is the market they've chosen isn't really one they're going to be interested in. And then you have a problem because you've got investors, you've got employees, and then all of a sudden you say, wait a second, this is not my problem that I really love. I'd rather be working on something else, right? Now let me shift to talking about funding specifically, which is what Hannah had wanted me to talk about. Specifically, how do you get funding? And I want to go over this again, because there's just so much advice that's out there. I do think some of it's actually pretty good. Places that you can go to read stuff. SaaStr, Jason Lemkin has a prolific Twitter feed and a blog where he talks about funding, which is actually pretty good. Paul Graham, who founded Y Combinator, also is pretty good. But again, none of these people are 100%. They are representing their experience. They don't represent. They're not always 100% right, in my opinion. I'm not always 100% right in their opinion, right? So take what you will from all this stuff. But the biggest thing in funding is actually to have like a multi-year approach to this whole thing, right? The goal of funding at the end of this is for the founders to have the biggest percentage, right, at the highest possible exit, right? That's what you're trying to achieve. And every funding round, there's a word called dilution, right? Where you know, if Hannah and I started out doing a startup, we each, let's say, and we split it equally, we each own 50%, right? Every time we take money, we go down. And particularly the dilution is the biggest in the earliest rounds, right? And so what ends up happening is if you're not careful or you're not capital efficient, you can, instead of ending up with 20% at the exit, you end up with 2%, right? The guy who did Box, right, who's a very, everybody loves the guy, he's a great guy, Aaron Levy, but he ended up, I think, with like 1 or 2% of the company because they had to raise so much funding, right, all the way through. So particularly the rounds that are most dilutive are the early rounds, right? Because that's where your valuation is lowest, and that's where you can end up giving away a lot of your company. So you have to be super, you know, incredibly resourceful with those resources, because every time you're taking it, you're giving away your most precious thing, which is a part of the company, okay? And so being really clear and understanding what you're going to do with that equity and how it works is super important, right? And then the fourth point is, what do I need in order to fundraise? And there's basically 4 things that I think, let's say 4.5 things I think you need, right? The first thing is you got to have a presentation. And now, again, every time I speak to college groups, sometimes someone will say to me, but I know Sarah. Sarah didn't have a presentation. She was able to raise, right? And what I'm going to tell you is, yes, there are some of those people out there who can do that, but that's the exception, not the rule. And I certainly wouldn't plan on raising without a presentation, right? And what is a presentation? It's first of all, it's your story and why you chose this market and why you care about this market, what your competitive advantage is, and how you intend to use the resources you're given to get to that next round, right? And so I think it's not that much that you should, you know, be expected to do this, right? Second thing you need in general is a demo. And a demo is not a finished product. It's not necessarily saying this is exactly what we're going to build, but it's to give people an idea of a visual idea of where you're going. And at the early stage, particularly, it's really important to show people, because a lot of times you'll understand the problem 10 times better than they will, right? Most investors are not, you know, necessarily 100% schooled in your market. You'll know more than them. Even though you may be, you know, 21, 22 years old, you're going to know more than most of the people you're pitching to. So making it simple for them, right, is really important, right? You should also have an ask, which is how much you're trying to raise, and some logic as to why the ask is what it is, right? And I do believe that there are some investors who will try and take advantage of younger founders. And so they will try and get more at a lower valuation, right? And so you want to make sure that you understand whether you're asking for money at 5 million valuation, 10 million, 15 million, what the difference is and why you can justify that, and be clear, right? And to be frank, a lot of it is just your confidence in the ask, right? And then if you set up competition and the number rises, even better, right? And then the last thing you need is a plan, which is how are you going to take the dollars you're going to receive and then get to the next round, right? Investors always want to know, what are you going to do with the money, right? And then the half thing that you need is, I would actually have references ready just in case people start to do diligence on you, right? And so that you can then begin to you can know who you want to steer them to. So next one, where does money come from at the early stage? And I want you to always know every round is hard. Fundraising is never easy. And the press likes to make and portray it as, oh, it's really simple. Someone threw $100 million at me, and that stuff happens. But in general, we live in a time where there's a ton of money looking for deals, but we also live in a world where there's too many companies, right? And so sometimes you're gonna, I mean, I don't know what the ratio is, but it's certainly, let's say I see 150 companies a year for every company that I fund, right? And for professional VCs, the number can be even higher, right? So there's a lot of companies out there. And so first money is really important. And where does it come from? Well, the first place generally is friends and family, right? People who know you. Now, again, I know not every one of you has friends and family with a big checkbook, and I'm not telling you that's the only way to raise, but it's certainly something I see. And the other thing about friends and family that's kind of cool is they generally don't care about valuation. So in general, you can kind of dictate the valuation to them and say, hey, we're going to do it at this. Now you want to do it at something that's fair to them. Usually I see like sub $5 million for that round. And the way you limit the dilution is you don't raise that much. You raise, enough money to say, okay, let me get to my seed fund next, right? The other place that money comes from early is venture funds. And venture funds encompass a wide range of people, and I'm going to talk about that a little bit more later. But there's also a wide range of investing philosophies, right? And so make sure when you talk to venture funds at this stage early that they're first check people. And usually you can discover that on their website, if they are, right? And understand that when you're talking to people who are not first check people, they'll be nice to you. They will, nod their head and smile a lot, but they're never going to write the check because that's not in their mandate from their LPs as to what they're supposed to do. And the reason they talk to you is they want to build deal flow and understand who's thinking about the market, what way, right? But they're not going to fund you early. So seek out venture funds that do first check and brag about them. The third way to get early money is what's called bootstrap, which is another way of saying your customers fund you, right? And customers in general, sometimes if you're in a market that's so important, they're willing to pay what's called NREs, non-recurring engineering, which is more or less a subsidy to a startup. And you can also, some folks are able actually to get revenue really quickly. And so they get, they get license fee, they get SaaS recurring revenue, and they are able to, control expenses enough that they can get to that next round and raise money, right? The other thing that is sometimes overlooked, government grants. My brother is one of the founders of the airport bomb detection industry, and he was able to get grants for both of his startups from the government, from the federal government, because they wanted to improve airport security, right? And there's other areas of the world where the government puts out money. And then the last thing is crowdfunding. There's a lot of companies that get started with crowdfunding. It's not as common in what I do in the enterprise stuff, because the crowdfunding, they don't understand yada, yada, SaaS vendor or whatever. With crowdfunding, you've got to look at the price of what do you pay to the crowdfunder to do this, and is it worth it? And then the other thing is, at the end of the day, you're going to end up with, let's say, 100 small investors. Are you set up to manage 100 small investors over time, right? Is it more of a hassle than it's worth? But again, that's another source of funding and another place. The bottom line here is always make sure that you find the right investors that align with your mission, because the right investors are worth more 100 times or 1,000 times more than finding bad investors, right? Who may take away energy from you, who may, try and over control you, right? Or tell you what to do or get in your way, right? So you want to make sure that you have the right investors and that you spend time making sure you have the right investors before you take a check. Very important, right? My sixth thing is that venture capital is a really, really broad term, right? And a lot of people are in that term. And so I want you always, before you talk to a VC, to do diligence on them, right? And you should know, like, what deals do they do? What round do they invest, right? And then the person you're talking to. One thing that sometimes confuses a lot of younger startups is there are these levels of authority in a fund, from associate up to partner, right? And frequently it's the associate who may find you. And then you're surprised to learn the associate doesn't really have any decision authority, right? They can bring deals, but they're not the partner. And so all that time you've spent with them is really just an intro to get into a process. It's not really a commit. So knowing who you're spending time with and mentally preparing of, okay, this is just the beginning of the beginning. It's not really a decision thing, right? And just as much as they reference check you and diligence you, you reference check them and diligence them. It's really important to talk to companies. Everyone has companies in their portfolio that didn't do well. My best references come from failures, right? The people, because they know how hard I worked to try and make them successful, even though things weren't going well, right? And I think you should get as many references on them as they get on you, and you should check what we call backdoor references, ones they don't give you, so that you can hear, who are these people, right? And again, we live in a world where in the good firms, a lot of times they're seeing, hundreds and hundreds of deals per partner, per day, or I'm sorry, per year. And they're going to do 1 to 2 per partner per year. So it's really hard to get through that funnel and to get to an actual decision. And so it's going to take time. It takes patience, and the longer along you get, the more it's metric based, right? At the beginning, it's more story based. But it's really important that you have your story right, so that you put yourself into the frame to be one of those, right? I'm sorry, was there a question there?
I think someone just forgot to mute their mic.
Okay, all right, good. And I'm almost done with my monologue here, so I promise we'll get to questions. The seventh thing is, when you raise, every time you raise, you're raising for an 18-month sprint. And effectively what you're doing is you're racing to the next milestone. And if you have a good investor, what they're going to want to know is, when they're looking at Hannah, they're going to say, can she get to the metrics to raise the next round, so that I can turn this baby over to the next round investor, right? And so even before you take that check of the seed, you've got to make sure in your head that your plan is enough to get to that next level, right? And what I see a lot of times is that, again, with younger people who are doing this, is that they leave too much open in their heads, and they say, oh, we'll experiment, we'll learn. And all those experimenting and learning, cause you not to get to the next goal within the 18 months, and you have to raise interim rounds. And those interim rounds are very dilutive to founders. And those interim rounds sometimes make it harder for you to raise, late stage capital, right? Okay, next, what can seed funders do for me? And these are the things that if I'm your investor, I should do for you. First, I should open my network. So my network should become your network, and I should be doing introductions to people to help you, right? I should help you with your story, and I ultimately should help package you for the next round, right? Because it's in both of our interests to get a next round, and my job should be to help package you. So one of the questions you should always be asking your seed funder is, who do you work with in the A round? Who are your preferred A round people? And I should go and introduce you to those people, and be not afraid to introduce you to those people. In fact, I like to do it early, so that you can go through the process as you can see what they're thinking, even before you get into a formal process of trying to raise capital. Now, some angels will be more on the engineering side, some more on the sales side. I'm not, but there's also people who do advice there. But what they should not be doing for you is operating the company, right? It's your company, you operate the company, you make the decisions. They're there to advise, to direct, to help you focus, but they're not there to run. Point number 9 is that the hardest thing to do, right? Most of the time when people are building a software, okay, and the hardest thing to do is to sell, right? And what causes more pain than anything else is when you don't understand how to reach the customer and you have to pivot. And pivots tend to be very expensive because they require sometimes new teams. They sometimes require new capital. They always require new capital, right? And what I think is that there's a lot of folks that kind of glorify or expect pivots out there in the world. But I'm telling you, deals where you've had pivots are ones where you end up as a founder with a lot less, right? And in Zoom, the founder ended up with, let's say, 22%, more or less. I don't remember exactly, but 22% because he was very capital efficient, right? And so that allowed him, at the end of the day, to still control 22% of the company, which is fantastic, right? I'm in another company where the founder is down to 6%. And the reason the founder is down to 6%, even though we are going to be a wildly successful company, is because for the first 3 years, we didn't know how to sell. And so we said, oh, we're going to try and sell direct to the customer. That didn't work. Then we said, oh, we're going to try another method. Then we're going to try another method. And by the way, we were laying every method on top of each other until we finally figured out this is dumb. We should be a channel sales company because all our competitors are, and let's go. But the other side of that was we had to raise 2 or 3 rounds to keep afloat as we were churning through what our business model was. And those 2 or 3 rounds were super dilutive, and meaning that the founder will get 6% of a company, which if we had been a little more thoughtful, we would have ended up with, even more. We wouldn't have needed that much money, and he would have ended up with 20%, right? And then last thing, how do I price a round? There's a gazillion ways to do this, right? Early on, mostly what people do is what's called a note with a discount and a cap, right? And the note says, your early investor, and these are commonly called safe notes where they don't have interest, or they're interest-bearing notes in some cases. I don't care. I think a safe note's fairer for the founder, but it doesn't matter, particularly given an interest rate that's so low. But those notes, the 2 critical things they do is they say, what's the discount to the A round? And usually it's about 20%. But more importantly, what's the cap? What's the worst deal your seed funders will get? And that can be anywhere 3, 5, 7 million, whatever it is, right? But those set effectively the price. Some investors will insist on price rounds, which you can do. I used to be religious about wanting a price round when I was early, because price rounds cover you as an investor in case the company gets acquired, or in case there's some issues. It's a little more detailed, but the cost is higher. And so you could sometimes spend, 15,000 in lawyer's fees, which comes out of your hide, right? You as the company pay it. Whereas these notes cost very little, quite frequently. And then the other thing to worry about is if you do find yourself popular for whatever reason, right? If you price the round too high, it can cause problems, because if you don't execute well, then the next round people are reluctant to come in when they see you priced too high. And for a seed round, my personal belief is the highest you should ever go is $20 million, right? When you get above that, then you're in gambling land, and you really run the risk. But most seed rounds that I see in Silicon Valley are between, let's say, 10 and $15 million these days. It used to be between 5 and 15 when I started, but things have gone up. And so you want to always be careful that you're not overpricing rounds. So anyway, with that, and seeing that some people are still awake, which is good, I thought maybe I'd turn it over and seek questions. And again, I'm happy to answer anything basic or tricky or anything, and share my experience with all you guys.
And just to make the Q&A go more smoothly, just raise your hand in the participants tab and I'll call on you. And before you speak, could you just say what your startup or startup idea is? So the first hand I see is Yusuf.
Hello, Dan. Thank you very much. This was amazing. I took more notes than ever. Hopefully that's okay. So my name is Joseph. I'm a grad student at Brandeis. I'm finishing from the business school in August, in 2 months. From now until August, I'm working on my startup, which is a data-oriented startup to help professors and universities and UX researchers find the data they need from human and people, not from imitators. For example, I worked in an AI project where we wanted data scientists to do a task. So we learned their techniques and we record all their steps. And it was the hardest thing to find data scientists, even though we offered a small percentage of a small money to them. So it was so hard. And that task developed that, okay, let's now find different people to do it, accountants, and it was so hard to find them. So I'm working on this platform where you actually produce the data and you can sell it as a person, and as a university or professor, you can request special kind of data from people. One example I like to give, if you want 10 people who have Fitbit who went to the T in Boston, just do that and you will get 50 people submitting it, and you can pay them if you want to. So my question is on your number 1 point, choose your founders wisely. I'm in that phase right now. I cannot operate without a co-founder, and I've been like having some hard time finding one. My own question that I always ask: should I keep working on it until I find one, or should I stop and never work on it until I find one? I don't want to stop because momentum is good right now, but again, a team is better than one person.
Yusuf, great question. First of all, congratulations on coming this far and on getting to where you've already gotten to. But I think like a lot of things in startup land, you have to work in parallel. Single tracking is not really good or effective as a way to work. So you have to, have that co-founder. Now, what I don't want you to do is use the work you're doing as an excuse not to go talk to, interview, meet, right? Because sometimes what happens, you say, well, I'm so focused on my product and I'm so focused on, figuring out what to go do. I don't have time, right? But the reality is if you don't, you have to find the time because it's super important that you do both, right? And so finding that technical founder, knowing what you're looking for exactly, and then interviewing to see if you can find it. And then making sure you've got a match, right? And I just think you have to be able to do both at the same time.
Thank you.
Ben Siegel, do you have a question?
I have few, but I was thinking to give the space for others. My question, so I'm Benjamin Siegel. I just graduated from Brandeis with Master in Neuroscience and BS in Computer Science. And currently I'm working in a company in LA and on the side working on an MVP for my idea. And my question is, how do you find the best strategic investors for angel investment / seed round? Because money is not that hard to find today, but the question is what you get out of the money you raise, I guess.
So first of all, Benjamin, thank you. And, sounds like you got a lot out of Brandeis, which is good. It's great to see someone, again, who's very accomplished and hanging the right path. Look, on the investor question, you have to do diligence on investors, right? I agree with you. There's a lot of money floating around these days, right? But just like investors choose you, you choose investors. And you should make sure you know what you want. And the reality is, the other thing to do is to look at, who's funded in your space, who's published, which investors have published stuff in your space that looks interesting, who's funded companies you admire, right? And go to those investors and contact them, right? And don't just wait for folks to choose you, right? And then when you do have folks choosing you, do the diligence on those funds or on those people, right? And I think that's a great way to separate the good from the bad. Actually, yesterday I was talking to a guy who's already got 50 people who want to invest. And he was asking me the same question, which is, how do I winnow from 50 to the 5 I want? And I said, it's dead simple, right? First of all, trust your instinct when you're in the room with them. If you don't like them, they're selling you right now. If you don't like them, the relationship's only going to get worse, right? So just X, no matter who it is, X off the people you don't like, right? And then let's say you get down to 25 that are credible, make a few phone calls, right? And you're going to be amazed how you start hearing the same things about people, right? You're not going to have to make 10 calls to get the picture of them. It's 1, 2, 3 calls, and you'll get a pretty clear idea of who's useful. And then, the other thing that's obvious is figure out what you want in an investor to make sure that it matches what's there, right? I was thrown out of one company recently, the first time in 10 years this has happened, where they said, we don't want you. And I said, okay, tell me why. And they said, we actually need help on our MVP. We're not sure we've got the right MVP. We're not sure we've thought about the right way, and we want more product people investing in us to help advise us. Like, okay, that's not me, right? I'm not that, So know what you want so that you can filter around what you want, right? And then, as I said, the other thing is make sure that, the people you have can bring you intros to the next round people that you want. So If you say, okay, really, I need to work with Sand Hill Road VCs, make sure that people have relationships with Sand Hill Road VCs, because that's your best intros when your existing investors walk you into those places.
Just a short follow-up. You said in the talk that it's good not to overprice yourself when you do rounds. And I would like to know why, like more deeply. And then second,
Sure.
how do you leverage and maximize the terms that you sign, if it's percentage or what you get from the investor other than the money? Especially in a seed, let's say seed, angel, Series A, max.
Right. So the problem, the reality is why you don't want to overprice is you never want to do a down round, because that a number of investors won't participate in down rounds because they're painful to do. You've got to have a lot of arguing and fighting. And so let's say, again, just in my world of an early seed round, if you get over $20 million as a valuation, let's say, and let's keep it simple, a pre-money valuation before the investors write the check of 20 million or over, a lot of times the Series A guys, their mandate is between 20 and whatever, 60 or something, right? And so if you start getting up there and then you don't execute perfectly and you've got some holes, the easiest reason for them to say no is because, oh, the valuation's off, right? Or because you might have to do a down round. So you may say, oh yeah, I'm gonna optimize around price. Look, what a great price I got, and I was able to take in more money and I'm gonna get farther. But you know, if you don't execute, then it's all risk. Now, I've been part of companies. I'm part of one company, a company called Psycognito, where the founder said, "I hear you, and I don't care." And he's been blessed. Every single round, it's worked out. So, right? But I've certainly seen others where they screwed this up and they took in too much money, and then they couldn't raise the next round because they were viewed as fat and not successful. In terms of how do you get whatever other value you're going to get, it's not contractual. That's handshake, look in the eye, you know, and there has to be trust in order to get those things.
Shin,
Thank
you're
you so
up.
much.
Hi, yeah, thank you for your presentation. So I have two questions. First is, at what stage would be, I guess, appropriate for seeking for the first round of funding? And second question is, if we have if we're in a team with a lot of people, but only 3 founders, initially, what are some good benefits to give to the other team member who are not founders or co-founders?
Okay, great questions. So here's the reality. You want to go as late and as long as possible before you take money, because that will give you more leverage and more milestones done. So what I always advise is you go as long as possible without starving, right? Now, because we don't want you to starve. We don't want you to be, you know, in that high distress level. But as long and as far as you can go, you are more likely to get a better and higher valuation. If you show up with just PowerPoint, again, odds are at the very first money coming in, it's going to be much lower. And if you show up with, you know, product and people using the product, again, your valuation is going to be much higher, right? So the idea is, you know, you might want to take a little bit of funding so people can eat, and then you try and raise the seed round a little later. You might say, no, we're going to bootstrap, which we talked about, or you might just say, we're going to just, you know, take another job and work at night, right? And then in terms of the 3 founders and all the other folks, what typically people do is, first of all, you have to figure out, are the 3 founders equal or not, right? And how does that work? And then for the other folks who are helping, you give them smaller amounts of options, right? And given that, you know, you have to ask the question, are they helpful going forward, or is their use done once this early project is done? That's how you decide how many options you give them. And usually, quite frankly, it's not that much for people who are helping and then disappearing. But if they're going to have a long-term relationship with the company, then it's okay. But you know, usually the first employees and first engineers will get around 1%, and then things drop like crazy after that, and it goes down to, you know, 0.25%, and then down to, you know, small numbers. And similarly, sometimes your first consultant or first helpers or first whatever will get something like maybe 1/4 or 0.5% if they're going to be ongoing useful. If not, then you just give them a number of shares and say, here's a number of shares and thank you very much.
Okay, thank you very much. It's very helpful.
Yusuf, you can ask your question.
Thank you. My question is a little logistic-wise. You mentioned Silicon Valley a lot. So is it true that if I actually want to found a company, I should go to the Silicon Valley, which I'm okay with? I just want to make sure.
Okay, so this question I think has changed. I mean, sorry, this answer has changed in the last 90 days, right? Before, I actually would have told you, yes, get on a plane, get out here. But recently it seems that people are learning how to use Zoom, right? And that investors are saying, hey, I can deal with functioning over Zoom. In general, quite frankly, I have a prejudice against the Boston VCs, right? And I know we're recording this, and so please don't copy this part and send it out to the Boston VC community. Actually, I would say the same thing publicly, so whatever. But in Boston, you have so many overeducated people that the VC game in Boston historically has been like a little bit snobbish, right? We're looking for the most crazily educated. And out here, it's been nobody cares where you went to school. It's like, tell me what you can do, right? And so but these days, again, I think a lot of people, I've certainly, every deal I've been introduced to in this pandemic time has actually not been located here. Or I shouldn't say every, but most of them haven't been located here, which is a good sign because I think a lot of people are not looking at stuff here as much anymore. And so I think there is hope. You don't have to necessarily move out to California. There's just so much VC money that's here, though. At some point, you want to make sure that you can get into those funds because, number one, they pay high prices, right? They actually pay really, really high prices, and they have really good networks, right? There's a reason those funds are do well, and it's like in Zoom, we took money from Sequoia in their growth fund. Those guys have been fantastic supporters of the company, and it's really been a real privilege for us to be part of that, and it's helped us with customers. It helps some of our customer momentum. So I wouldn't want you to preclude yourself from doing that no matter what you do. You want to always be able to have those doors open. And quite frankly, the other thing is if they're involved, the price of the round goes up. So, you want generally they're A-round investors. Generally, you want them, interested in the A-round. And so, yes, but I don't think you need to go to Silicon Valley anymore, particularly if you can find angels who are can connect you into those funds, right?
Thanks.
The same few people are raising their hands. Is there anyone new who has a question? Okay, Ben.
Another follow-up question. Would you recommend to go to a fund that invests from seed to Series F, G, or would you say that it's smarter to start with funds, because a lot of them do only Series A and seed, and then go to those growth capital funds?
So Ben, that is a phenomenal question. And here is what I believe. Okay, I'm going to tell you a story, and then I'm going to tell you what I believe. So many years ago, when I first started, I was in a big venture fund, and I saw a kid who was probably 22 years old, 23 years old, sitting on the floor of a conference room with paper everywhere and an actual telephone. And I said to the partner, like, what on earth is that guy actually doing? And he said, well, welcome to our seed fund. We had a seed fund. We didn't know what we invested in. So he's calling to say, do you still exist? Did you raise a round? Did you call us, right? And that was like a clarion call of what these bigger funds really care about. They don't care early, they care later, right? So my bias is there is no such thing as a seed to, stage F fund. I just don't believe that. I think you want that different people are better at different stages of things, right? And even again, Sequoia divides it. You have early stage people, you have growth people, right? And they're different. They're not the same, right? Um, so my preference generally is to take seed money at seed and then go to those kinds of funds later, because I think they're better and they care more later, right? I just think that sometimes these big mega places who now all of a sudden preach vertical integration, right? I don't know how much they really care about seed. And if they do come in and they tell you, we care, we care, we care, I would reference check and make absolutely sure that that's true. Because in general, again, from seed to exit is average 7 years, right? Plus, maybe now even more. And, the Series A, it's probably 4 years, 5 years, right? And they may well say, given the fund, we're more incented actually to worry about the Series A. That's where we spend our time. We like those problems better. And so, yeah, you get the brand name, but you don't get any of the time, right? And I don't want you to end up on the floor as a sheet of paper, right? As someone's trying to figure out, what do those guys do? Like, why did we invest? Yada, 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 right?
Shin, do you have a question?
Yes, I actually have 3 more questions. So one is, at what stage is we we should get a lawyer involved, or like any other legal things? Second is there anything that are like, is there any downside for seed funding? For example, whether if the seed funders, will they take any percentage of the company? And also the third question is, when is a good stage that we should register for as a company?
Okay, great question. So let me take the last question first, which is, should you register as a company? When you are serious and when you are able to allocate the equity between the 3 of you, right? And if you guys are all going to be equal, then it's easy. Then you register sooner, right? If there's still some doubt about, well, maybe Shen, I should get more because I think I'm more driving this, and the other 2 should get less, then I would wait till that's resolved before you register. In terms of getting a lawyer, the way most lawyers work out here, and I'm not sure if it's true in Boston, but they're willing to give you some amount of legal service for free, usually up to like 25K. And my view is you should get a lawyer, get the best lawyer you can, right? Because it'll save money over time. So someone who's done this before, right? And then what I would do is figure out how much they give you for free. And then generally where you really need it is as you get closer to doing a financing or a term sheet or that kind of stuff. That's where you really need their help, right? In terms of the downside of seeds, so yes, every investment is effectively buying part of the company. So it's the seed negotiation is going to be how much money do you take and how much of the company do you give up? And by far and away, the biggest downside of seed funding, it's not a downside, it's just that's what it is they take part of your company and they dilute you, right? And so knowing how much money you need and figuring out at what valuation and what dilution you're willing to accept, right? That's the art of this whole thing. And knowing, how much money will it take me to get to the next round, right? And having that planned out is critical, right? And, the guy who founded Zoom came to me and said, okay, I'm going to sell only to small business and education, and I'm going to get to probably $2 million with this round of money, and then I should be able to raise my A round. And that's basically what he did, right? And so, having that kind of level of specificity and knowing exactly what you're going to do with the money you get and how long it takes is super, super, super important, right? And the sin is if you don't take enough and then you have to go raise again and then dilute yourself, right? So you have 2 rounds of dilution before you get to an A round. That, in my world, is very expensive. That, that means the founders get harmed because you don't get any more stock. You're just going down as a percentage, right?
Okay, thank you.
Wajanka?
All right, somebody new.
Hey, so a question. when you invest in that first round, how do you evaluate companies who don't have any revenue when it's still the idea stage? They haven't had customer interactions, but they have the big vision and anything is possible. And then how do you evaluate companies who already have some revenue, but you can see some gaps in there? Could you speak about the difference?
Totally. Thank you very much. So when I sit down and I look at the very first stage, I'm usually looking at companies with no revenue. And what I'm looking for weirdly as a seed investor is risk reduction. And what is that? It means who's got the best plan and can execute against that plan, right? So I'm looking and saying, how thought through is this, right? And what are the odds of success and how much money are we going to need to raise to get there? And I'll tell you something, which is to some extent, and this is, I'm being a little bit extreme, but I've come not to care about the product that much because that can change, right? And one of the strangest things is the founder sometimes 90% cares about the product, right? And I maybe 10% care about the product, right? I care about, do you understand how you're going to find your customers and what it's going to cost to get those customers, right? Traditionally, there's two expenses. There's marketing, right, where you have to go to shows or do buy Google AdWords or Facebook, blah, 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 right? And then there's salespeople, right, who get a commission, but you've got to hire, train, support all those people, right? And what I love is to have people who've got clarity of vision around the first customers. And that's when I find technical people with clarity of vision, that's when I get greedy, right? And again, go back to Zoom, the guy said to me, we are going to sell to education and we're going to sell to small business. And then we're going to build kind of a reverse wedding cake. The next layer will be slightly larger and that's going to be medium-sized business, right? And then we're going to sell into enterprise, right? And here's how that progression is going to work, right? And in fact, what I'm going to do is hire very cheap SDRs, right? And BDRs. I'm not going to hire expensive salespeople for 2 years. And I'm going to go. And so anyway, so that's what I love. When I see companies with revenue, a lot of founders sometimes will sell the revenue as like their product to investors. I've got 500K of ARR, right? And you see that almost as the first line. And it sometimes is a tell, and it sometimes is not. Because there's a company, I just invested last year in a company called Speckit, who are two women who are attacking the learning on top of Salesforce at the moment and other platforms as we go forward. And they came and they were spending a lot of time on this. They had about 200K of revenue, and they're going, really proud of it, right? But what I quickly realized is that 200K of revenue didn't really matter to them, right? It was all these random things they had done that wasn't part of their long-term story. So they really didn't care that much about the existing customers. And quite frankly, what's happened has been those customers have churned, right? And they've had to kind of start all over again. So revenue, yes, revenue is important. And the more revenue you have, the better price you will get. But the quality of the revenue really matters, right? And so for me, it's got to go back to that story of, do you know who those customers you're aiming for are? Have you hit it, right? And in tech speak, what we call that is, do you know your persona, right, that you're aiming for? And do the customers fit the persona? And I would say like probably 70% of the time when I see companies with revenue, the customers don't fit the persona. They will say, we want to sell to, in Speckit's case, it's like, we want to sell to new adoptees of Salesforce who are having trouble doing training. And then when you looked at their actual customer, they were old adoptees of Salesforce who had different problems. I'm like, these things don't connect, right? So why are you telling me one and you're actually doing two? And it raised more flags than it was worth, right? And so I think this again is one of the hardest things, is just, making sure you have and you understand, how to do this. Now, the other thing is later, as you get to later rounds, particularly in SaaS companies, you will be judged more by metrics. And one of the most important metrics is the CAC, the customer acquisition cost. And, what some folks believe is that's the metric that really matters above everything else. Like, what does it cost you to find a new customer? Because that shows how viral or how easy it is to sell your product, right? And so I think from the beginning, focusing there is not the craziest thing. Saying, okay, how am I going to reach customers what's my methodology? What does it cost, right? And is there a lower cost way to, to reach these customers? That's part of the magic of, again, making yourself attractive to future funding people.
Ariana?
Hi. So what's your opinion on companies who are coming to you with their like main monetization strategy being like ads?
Great question. So I'm the wrong person to ask there because in general, I'm not going to fund those companies. But I would say in general, when I talk to people out here about it, the question becomes is that business is you're competing with Facebook, Google, maybe a few others, Amazon, Pinterest, I don't know. But can you get scale, right, in that business? And then all the crazy problems of ad-supported businesses, like the privacy issues, the personal PII problems, right? So for me, I don't really know is the real truth, that I shouldn't give any advice, but I just know that you've got to have thought through all that stuff. And then can you get to scale in an ad-supported business today, given the consolidation that's happened among the ad-supported platforms?
Thank you.
Manish?
Hey Dan, this is Manish. I finished my master's from Brandeis Business School. So I'm interested in the venture capital space. So my question to you is, typically when CEOs or founders of these startups go for investing, I think valuation is like one big aspect, and the interest and the discount. So how do founders like arrive at the valuation? Because typically what happens is you quote a value and then investors typically try to get that down, and the negotiation happens at finding that optimum valuation.
Right. And so you're absolutely right. And it basically, the way it works is either you have either you raise more money at a higher valuation, or you raise less money at a lower valuation. There's a dilution percentage that really matters, right? That's what really, really, really matters, is what percent of the company you're giving up. And then you work backwards to say, okay, how much money do I need to get to the next round? How can I use that money efficiently to get to the next round? Is it enough, right? Mm-hmm. So the real way it works is it's a negotiation. And like any negotiation, it works in kind of a subtle way. But the way that I find is that the best founders will actually set valuation expectation almost in their initial presentation, right? Which is, we're trying to raise $2 million on a $10 million valuation, right? And here's why, or here's what we're planning to do with it, right? Mm-hmm. And so I do find that the best founders will put the stake in the ground, and then we'll figure it out after. We'll debate, negotiate, whatever afterwards, right? I think it's a mistake to leave it up to the first offer, because then sometimes the first offer will come in either with too low dollars or too high dilution, and sometimes it's hard to get people out of that once they've made the first offer. So my advice to founders is always put the stake in the ground, right? And yes, you may lose some investors because the price is too high, right? Or the amount is too high, but you're better off kind of getting a sense of what the market is by you putting it out there, as opposed to, particularly when you're just out of school and you're young, potentially letting them kind of take advantage of you in the situation.
Yeah, thank you.
Jacqueline?
Looks like she may be frozen.
Jacqueline, do you have a question?
She may have just left. I think she froze.
Okay, we can go to someone else. Ben Siegel?
I think I'm good with the general questions.
Okay.
Thanks, though.
Some of you still have your hand raised. I don't know if you still have questions.
These are great questions, by the way, so thank you.
Youssef?
Yes. Very quick question about the evaluation that you mentioned. How do we evaluate when you say that you don't really care about the product yet, and because it's going to change and it's going to pivot for sure? So how do we evaluate the company at the initial pitch for investment?
Again, for me, it's the quality of the plan, the quality of the team, right? And for me, it's about the clarity in how they plan to sell the product. And sometimes I was talking to a really charismatic founder last week who said, I'm going to build this. The need is so vast. I'm going to launch it, and then everything's going to work out. And I said, oh, you're going to let your customers choose you? And he stopped. He's like, no, I don't want to do that, right? And then immediately he's back into this loop of how do I find the customers I want at the right stage, given the product I've built, right? And I thought, he was trying to optimize to say my product should sell itself because there's such a demand. But what he wasn't realizing was that he was basically setting up an incredible sales pitch where he was going to lead himself into a mess, right, of random customers, right, some of whom might be too big, might have too many feature requests, some of whom weren't right for the stage of the company, right, and that it really wasn't an impressive answer. And the more he thought about it, so I'm looking for people who've got, in general, I tend to invest in more experienced teams because I like the people who've figured out how to take a product to market, because that's the biggest risk in all of this, right? For seed investors, it's the go to market.
So it's 6:30. I think we can wrap things up. A few people have more questions. Dan Scheinman is a mentor